नमस्कार दोस्तों, welcome to Knowledge Circle. In this video, I'm going to try and explain the Silicon Valley bank crisis in simple terms. Let me first tell you a little bit about Silicon Valley Bank by looking at the name. You can easily understand that this bank is located in the Silicon Valley area of California. And as you know, Silicon Valley is known for being the center of tech industries in United States. It is a region in Northern California, primarily located in the southern part of San Francisco. Bay Area, the region is home to many of the world's largest and most influential technological companies such as Apple, Google, Facebook, and many more. Silicon Valley is also known for its startup culture, where entrepreneurs and investors work together to create new and innovative businesses. This culture has spawned many successful companies and has led to the development of new technologies and industries. Now, if at all a bank exists in this region, basically in the middle of startup culture, where enterprises and investors work together to create new and innovative businesses, then you can easily understand that the primary role of this bank is to help technology and innovations company by giving them financial services such as loans, accounts, and investment advices to help them to grow and develop their product. Now, what does this bank do? Basically, this bank would give loan to venture capital or PE firms. This VC or PE would in turn invest in startups. There might be possibility that this bank would directly give a loan to startups. Now, where would startups keep their money? See, startups are also going to earn some money. Would they also keep their money in some current account? Obviously, yes. We have understood that SVP is a bank which give loan something to PE or VC firms, or they can also give loans to startups. And in turn, startups also deposit their money with SVP. Now let us try to understand about the balance sheet position of this bank. So their total asset size is 2,11,793 and figures are in millions dollar. Out of this total asset size, you can see that almost 73,614 are loans given to VC and PE or directly to startups, as we have seen in previous slides. See, there is a small adjustment here. So here actually the breakup of 74,250 has been given in next slide. So you can see out of these major chunks, the loan to global fund banking. And this is something like the VC or PE fund, and that is 41,269. If you just calculate, almost 55 to 60% is given in the specific area only. Now this is not a problem. Now if I were to focus on one more big figure, that is 91,321. That is in security, held to maturity. So basically STM are like long-term security. They have invested in government bonds. These are pretty much sure. Then what is the problem? Problem will come into the next few slides. Keep on this figure in mind. Now we have to understand that if they invested a lot in STM, question is, where did this bank get money from? I have already mentioned before, a lot of deposits which flow into bank. Now I am going to take your attention on deposit figures. If you see here, non-interest bearing demand deposit. So this current account, so this is nothing but a current account, and the deposit figure is 40 million something. This is in dollars in thousands, and this particular figure is in millions. dollars in millions. If you check out here for 21 and 22, this is dollar in millions. So in simple terms, in 2019, this bank had deposit like current account deposit, that is 40 and something. This now this went up to 125 million dollars, and that's a big jump. Now you can imagine if Silicon Valley Bank has almost three times raise in their deposits, what are they going to do? There might be two possibilities: either they give loan or invest somewhere wherein they get good yields. So they give some part as a loan, but maturity chunk they invested in HTM is 91,321. Now, if you see here in 2021, total investment security is 127. 127,959 something. Out of 127, out of 127 million, 98,195 has been invested in HTM security. Now, if I were to calculate this, this would be coming around somewhere 75 to 80% in HTM. They put roughly around it 77. Now, to understand this, let's compare this figure with 2019. Now, out of this amount, 29 something, out of 29, 13 in HTM, 13 in HTM, and 14 in something called AFS. Can be like short terms, 14 in short terms and 13 in long terms. So you can see out of the total investment, 50% in HTM. And from 15%, they jump to 75 to 80%, roughly 77% in 2021. I hope I'm clear. Now, one more big question that might have come up to your mind, that why did these deposits jump three times? Where did they get a lot of money from, or where did these deposits flow into this bank? Let us discuss in detail. Now you have some understanding of this bank. Let's try to understand how this bank went into crisis mode. If you remember, during the pandemic, that is in March 2020, the United States federal fund interest rate were almost near zero. In economics, zero interest rate policy is an interesting topic that is a part of macroeconomics. What happens is that a country's central bank, what they will do, they will set the interest rate to near zero level. It is usually done when there is a period of economic downturn and recession. And the logic behind zero interest rate policy is that borrowing money becomes cheaper. This will encourage businesses and individuals to take loans from banks at a bare minimum interest rate. Now, the whole idea behind this move is to increase the money supply in the market, which can help stimulate economic activities by encouraging borrowing and spending. However, there is also a negative effect. When there is more money in circulation, it can lead to inflation, because when people have more money in hand, then they are willing to pay more, when will eventually increases the price of commodities. And the second negative effect is it can also encourage excessive borrowing and lendings, which can lead to asset bubble and financial instability. So in economics, you have both good and bad effects. Every policy has to be carefully implemented. Anyhow, so during the period of near zero interest rate, that is in March 2020, the Silicon Valley Bank invested billions of dollars in US government bond. Now, investing in government bonds is often considered a safe investment, although the returns are very low. But then it is considered a safe investment simply because the interest rate that you get from investing in government bond is fixed, just like your fixed deposit. So, in simple terms, when you invest in government bonds, you are essentially lending money to the government, and in return, they pay you interest over a specific period. Now, what happened is that during the pandemic, almost everything was shut down, and we were locked up at home. There were barely any economic activities going on, and almost every country's economy badly suffered. Prices of commodities were skyrocketing. It was almost a recession, so many people lost their jobs. The supply chains was hampered. As a result, price of commodities increased. Now, as usual, any central bank during a recession, what they do is they start reducing the interest rates so that there is some money supply in the market. So in 2020, the Federal Bank of United States, they were cutting down the interest rate, and they kept it like that till 2021 end. And then suddenly in 2022 beginning, they started increasing the interest rate aggressively. Now, as soon as the Federal Reserve started raising the interest rate to combat inflation, government bond which the Silicon Valley Bank had, their price started declines. Why? Simply because the new bonds that will be issued by the government will have newly increased interest rate. The principle is similar to fixed deposit. I am not saying both of them are same. Obviously, government bonds give you higher returns compared to FDs, but the principle is the same. Let me give you an example. Suppose you own a bond that pays 2% interest and the interest rate rising to 3%. Suddenly, new bond being issued paid 3% interest, making them more attractive to investors. Now, in capital market, there are buyers and sellers, basically competition. So the value of your bond must decline. Only then the new bond will be attractive as well as profitable for investors. So this is exactly what happened with Silicon Valley Bank. They invested billions of dollars in US government bonds when the interest rates were nearly zero, and then suddenly with the US Fed Reserve started increasing the interest rate, the value of the holding held by Silicon Valley started declining. In the beginning, I told you that Silicon Valley Bank is primarily made up of tech companies of the United States. So in reality, it was the money of all these tech companies that were invested in the US government bond through this Silicon Valley Bank. Now, whenever the US Federal Reserve increased their interest rate, the value of tech company investment were declining. So to protect the investment, these tech company were pumping in more money, and at the same time they were having difficulty raising new capital. That's why you will see that all the technology stocks were falling since 2021 in United States and in India. The technology stock started failing in 2022. That is also the main reasons why we were seeing so many layoffs. Many layoffs, it is all a domino effect. Now when the technology stock start failing, that led to panic selling. Many customers who are technology stocks sold them, many book profit, and many had stop losses. So overall panic selling led to withdrawal enormous sum of money. Now, if individual and organizations go into panic selling more and they sell their favorite technology stock, where do you think the technology stock will raise capital to run their operations? Naturally, they will be forced to withdraw their deposits with the Silicon Valley. As a result, last week in Friday 10th, trading in Silicon Valley Bank shares were seized, and the bank has given up all effort to raise fund or find any buyers. Now the government has stepped in. The bank is practically closed, and it has been placed under Federal Deposit Insurance Corporation. They take over the control of bank assets, operations, and ultimate goal is to sell or liquidate the bank asset to pay off its creditors and depositors. Individuals and organizations and tech companies were withdrawing their deposit. Basically, some were panic selling, some were booking profit, and some needed money to run their own operations. So all these situations led to heavy panic selling. In other words, the customer of Silicon Valley Bank started losing confidence and started selling to withdraw their cash. Now this is a run on bank situation. See, a bank like Silicon Valley Bank run like this, it can cause even a healthy bank to go to bankrupt in a matter of days. In India, if a bank goes bankrupt under the DICGS Act of 1961, every depositor in a bank is insured up to maximum of rupees 5 lakhs. Now please don't think that if you have 1 lakh rupees in your bank, you will get 5 lakhs. No, 5 lakh is the maximum. So it is going to be loss. If somebody has 50 lakhs, then they will only get 5 lakhs. Now, like in India, we have Deposit Insurance Creditor Guarantee Corporations, DICGS. Similarly, there be something in USA also? Answer is yes. I would want to show you how much insurance is available for all those companies who have invested their companies or whatever entities who have invested in such banks. Here you can see the standard insurance amount is 2,50,000 dollar per depositor. Anyhow, this is the entire story of Silicon Valley Bank. I hope you found this video informative. Thank you for watching it. Thank you very much.